If you want to expel and grow your business to the next level, buy more real estate, and really master your finances, and this is the podcast episode for you because we have a legend, a man who has over $350 million in multifamily. He's a best-selling author of a book called Barbaro Profits, had a massive company called Jake and Gino, you probably know of, and to make it even more impressive, he's giving back and teaching you how to create passive income, build wealth, take control of your destiny. We have the one, the only, the myth and the legend, Gene Barbaro. Thanks for
Jordan,
being
thank you.
here.
Thank you for having me on. I am a legend in my own mind. That's first and foremost. I'm sure my wife agrees me with that sentiment. How you doing, brother?
I'm doing fantastic. Happy to have you here. I love your
Thank you.
story.
Thank you. And let's just kick it off by starting that. I think one of the premises that we wanted to talk about was in this market right now, how doesn't it stop you from doing deals? And I want to
Mhm.
take the listeners back to 2011 when I started investing with my business partner, Jake Stenziano. I had met him through my restaurant. He was a pharmaceutical rep, and I was the pizza guy. So we were the pizza guy and the pharmaceutical rep. Jake moves down to Knoxville in 2011. And everyone says that was the best time to get into real estate. I wish I had gotten into it. Well, not really. Because if you remember how it was back then, you couldn't
Mhm.
finance a deal. You couldn't raise capital. Rents were like $300 for a one bedroom in Knoxville. It was a terrible. The sentiment was terrible. GDP was terrible. But we decided to start. We didn't know any better. We were just really hungry. And the key was we were ready for change. So if you're struggling with this market right now and you're saying to yourself, I'm not sure, you have to check yourself and say, am I ready for change? And I was ready for change. I had a lot of pain. I wanted to move from desperation to inspiration. So that's the first step. The second
Mhm.
step is you have to understand that you know that you can change. And I knew that I could change because I went and I did my mentorships. I learned the business. I had some success before. So understanding that second part, yes. And then the third part is yes, I am ready and I'm going to take massive action right now. And that's what happened to Jake and myself. Unfortunately, it took us 18 months to find the first deal. So if you all think you're having problems right now, Stenziano and Barbaro in the Southeast back in 2011, we had a lot of people saying to us, y'all ain't doing business down here. And
Mhm.
I didn't understand why. I mean, we're two Italians, two guys from New York. They just didn't like us. But more than that is we just didn't understand how to communicate with the brokers of the world. It was more on us than on them. So if you're struggling right now in this part of the market cycle, you're not alone because we have also last year we only bought about $15 million in real estate. We averaged between $25 and $30 million a year. So it has been slow. It hasn't been slow just for you, but it's been slow for everybody else. And just to like really put a bookend on that story, it did take us 18 months to find the first deal. But then after the first deal, 3 months after that, we found our second deal. And I think the key is to
Mhm.
really in the multifamily space and in the commercial space to align yourself with amazing brokers out there because brokers are the gatekeepers. And we can talk about how to align yourself with a broker and how to become more knowledgeable and how to really just create that relationship. But man, if you're struggling in the market right now, you are not alone and things sooner or later will break up because it is called the market cycle. The
Mhm.
market cycle will shift.
I love that. Super inspiring. And like, two-part question for you. One, you had a business already, you're doing restaurants. What made you like have the belief that you could leave that working business and start doing commercial real estate, investing in multifamily? And two, how do you stay committed for that 18 months period to find that first deal? Like, okay, it is gonna work. I can do this. This is for me. A lot of people it takes them 3 months and they quit. You did 18 months and now you're massive, so you stuck it through. What was your big belief around that?
It was a while ago. This was probably be 2008, 2009. It was a Friday night in New York. I'm in the parking lot of my restaurant. I'm all by myself. It's snowing
Mm,
and I'm shoveling the snow from the driveway. I've got salt, calcium chloride. I'm throwing it in the driveway. I'm freezing my ass off. And the only thought that's going into my mind on a Friday night is, well, guess what? I'm not getting paid again. I'm
mm,
working for free again. This sucks. I want this to end. I want to create some kind of income on the side. I can't keep doing the same thing. I mean, I heard that insanity was doing the same thing and expecting different results. And that was me. But as I'm out there freezing my ass off, all alone, without hope, I look up, and at the building of the restaurant, my mom owned 3 apartments upstairs. And in one of the apartments, the light was on. And I said to myself, Mom is home right now in bed, getting paid while I'm out here freezing my ass off and I'm not getting paid. And I equated and I said, wow, multifamily owners, real estate owners are getting paid in their sleep, and they get paid every month. And that's when I finally understood that, hey, for me to build wealth, I need to get into this real estate space and I need to understand how to do it. That was the inspiration for me. I knew that what I was doing ultimately long term was not going to create the wealth and the lifestyle that I wanted. And that moment in time is when I decided I need to take some type of change, because I had good role models. My parents were both immigrants from Italy. They had some properties. I just didn't know how to do it on my own. That's when I took that next step. And I wrote down the second part of that question. The second part of that question was, how was I committed? In 2008, shortly after that episode in the parking lot, I pick up this book by T. Harv Eker called The Secrets of the Millionaire Mind. And to me, it was a life-changing book, because at the very beginning, I read the book and I was truly angered at T. Harv Eker. It's as if he was speaking to me and insulting me and telling me, Gino, you're a failure. Everything you've done up to this point in your life, that's the results that you have. It's all because of you. Your fruits are in your roots. Well, my roots were shallow, so obviously my fruits were non-existent. And I took that as an assault and affront on myself. But when I calmed down and I got out of my emotional brain and I let logic sit in, I had to sit down and I had to be real with myself. I was blaming everybody back then. I was blaming Obama. I was blaming Bush. I was blaming the bailout. I was blaming the recession. The only person I wasn't blaming was myself. And I found that to be very odd, because I couldn't control any of those things. The only thing I could control was myself, the thoughts that I had, and the inputs that were coming into my mind. Once I realized that, it was sort of a sigh of relief. I didn't have to be that person in the parking lot throwing salt and working another week and not getting paid. I could start learning something else. And from there, that whole pain that I felt, I said, I'm going to be moving from pain to pleasure. And I found real estate, and I actually really liked the business of real estate. I liked multifamily. I liked dealing with tenants. That's, when you're in the restaurant business, it's the same sort of business. You're in customer service. You're out there to provide a service and out there to provide value. And I had a pride of ownership with the real estate that we did own. I had a 3-plex. My mom had the restaurant. So we really had pride of ownership. So I'm like, I'm committed to this because I have 4 kids. At the time I had 4. I'm going to do this. And one last thing that I'll say is, when I finally went up to my wife, and I told my wife that I'm going to take this step into real estate and I want to ultimately leave New York and go to Florida, my wife didn't hesitate. Maybe for 3 seconds. She said, you know what? I trust you.
That's amazing.
And when your spouse says, I trust you, you have to do the best, that you have to put out as much effort as you possibly can, because they gave you trust. The only way I cannot let her down is by putting in a ton of effort, by being rejected for 18 months, by putting in offers, by hearing a bunch of no's. And then ultimately somebody does come around and say yes. But what I like to call, I was radically accountable. I just held myself to an account because Julia said yes to me. And I can't let her down. I can't let my kids down. I can't let my kids see me going to work every day, hating work, coming home, and just being grumpy. I didn't want them to equate that to work. So those are a lot of the factors in my life that led me to not quit for those 18 months. And I'm speaking about this. I'm looking directly into the camera, speaking to you and saying, where do you have that discomfort in your life? Because you need to have a little bit of discomfort. You need to understand that you want to change, because there's 2 kinds of people out there: people that are comfortable and they're just okay. And then there's ones that are really uncomfortable. And then there is a third one that are really crushing it and want to take it to the next level. The ones that are uncomfortable or the ones that want to take it to the next level, those are the ones that affect change. Those are the ones that are willing to wait 18 months. Those are the ones that are willing to put in offers with Jordan, and Jordan coming back and saying, Gino, you're off by $1 million, brother. We'll get to the next one.
Mhm.
Okay, we'll get on the next one, but I want to hear about the next one. That's, in my opinion, what it takes to be committed and not to quit after 18 months.
I love that. So powerful. I think it really speaks volume on having like external forces to help you stay in the game. A
Yes.
lot of people, it's more internal. I want to make a lot of money. I want to buy a property, and it stops there. But for you, it's like, this is my family. This is my wife. This is my kid. I have to do this. If I don't, I'm gonna feel even worse. That radical ownership is just so imperative, I think, in real estate, in this market especially.
Jordan, it's interesting. We were talking before we hit the record button, and I'd mentioned the word legacy to you.
Mhm.
And the word legacy to me is powerful because most people, when they think of legacy, they think of just the financial part of legacy. And that's important because I do want to leave a legacy to my children. But
Mhm.
legacy is not something you leave, right?
Mm.
Legacy is something you set in motion. So I think unconsciously back then, I did want to become financially free, but I did want to see my kids and have my kids see the values that I had, right? The values, the belief in God, the belief in hard work, the belief in building something, the belief in building a foundation. I wanted them to witness that. That was part of the legacy. So the legacy for me really is three components. It is financial, but it's also faith and values based. And it's also networking and relationships. The families, there's three components to that. And
Mhm.
that's why for me, 18 months is nothing. If you're 40 years old and you're going to live to be 80 or 90, you've got another 40 or 50 years. What's 18 months in the grand scheme of things? We get so worked up. Just take a step back and think of what you want your legacy to look like when you're 80 years old. What does that look like? Then you need to reverse engineer that, bring that back to today and start working on that today. And from there, you have the vision of what that looks like. And every time you get a no from Jordan or every time you get a no from an investor, it's okay. One other door will open up eventually. That's, I think, how you stay for the long term. Create yourself a vision of what you want your life to look like. I didn't want my life to look like being stuck in the kitchen,
Mhm.
washing dishes when I was 64 years old, being grumpy and just being bitter in life. I didn't want that. I was afraid of that. I was afraid of being slothful, being really lazy and saying, you know what? God has given me these gifts. I'm a rather intelligent person. I had two amazing parents. I had a foundation and I squandered that because I was too afraid to take a chance. I didn't want my legacy to be like that. So for me, there was no quit once I understood T. Harv's message of responsibility and taking control.
That is, I think, next level. A lot of time I hear about legacy. People say it's like money or an empire, but for you, it's like it's more than that. It's like a way of life. It is a thing that is in motion to make a bigger impact. And
Mhm.
for you, do you like prioritize the three pillars of like financial, faith, networking? Like, how do you use a framework around that? I guess.
That's a great question. I mean, the way I would look at legacy is the three pillars. So I'll break them down for you because I think they're rather important when you look at it from this perspective. Now, the financial aspect to me is really important. I read a book by David Green. He's the founder of Hobby Lobby.
Hmm.
And in his mind, he actually thinks that he doesn't own anything. It's all really God owns everything. So
Hmm.
I've sort of adopted that aspect, but I am the steward while I'm here. I need to grow these assets. I need to nurture these assets, and I need to teach my children how to nurture and grow these assets. And one way I'm doing that is I'm allowing them to invest in my deals. I've created personal financial statements with them. They are running their own businesses as well. And we are creating a company called Barbaro 360. That's our business. So I'm teaching my children to become really great financial stewards of the assets that I'm going to leave and going to perpetuate. The second component is what we call the family or the faith. So for me, family and faith is really important. I realized that my job as a father
Hmm.
is to get my kids to heaven. So how do I do that? By prioritizing God and by being with them, by going to church with them, and by teaching them those values. And family is very important with us. We have certain rhythms in our family, we have certain cadences in our family. We speak about things in our family openly. And I think that's truly important. In the family component, there's something that we call human capital and intellectual capital.
Hmm.
Now, human capital is really cool because all of my children are unique. One of the roles of my legacy is I want my children to adopt what their human potential is, what their sole purpose is. One loves money, one loves theology, one loves the farm and pottery, one loves to do massage. Whatever that is, I want them to really fulfill their purpose and their passion. That's what legacy to me is as far as the family, and how can the family support each one of us. The intellectual capital is really cool because I've written books with the kids. I'm actually doing a podcast called the Happy Money Podcast with my son, Michael. He's 23 years old. So that's intellectual capital. I'm hoping that Michael's kids, my grandkids, will one day be watching videos about his dad and me talking about money. How cool is that? So the legacy component isn't really only about money, like I keep saying.
Yeah.
That's an amazing component to have your grandchildren watching you and teaching you about that stuff. So when you talk about legacy, let's wrap it up into those three pillars of the faith in the family, right? Of the financial, which is important, and then of the networks and the relationships. If you look at it from that perspective, then you have to start creating what we call in the faith component a family mission, a family constitution, core values, mission statements. Those are truly important because when you think of legacy and family, it's very similar to running a business. When you're running a business, a really successful business has all of those attributes. They have their culture set in place. They have their mission, their direction, their vision. I just want families to look at themselves as a family office, and every family office has all of these components, has the longevity, has the cathedral thinking. And if we can pull that into each family, ultimately, my goal is to have families with financial intelligence changing the world for the better. Could you imagine families that are empowered to do that, that are structured like this, that can talk openly about money with their kids, that can teach their kids about money, and then you have that pattern from one generation to the next? That becomes a tsunami. That becomes a tidal wave.
That ripple effect is really making an impact and like leading by example.
Yes.
So based on that, I can tell you love frameworks. You love having mission statements and structure. When you first got into real estate investing, did you have a special framework you used, and that changed since then?
It's an excellent question. And I'm glad that you asked that, because I always like to say that I had life before my business partner, Jake, and I had life after Jake. Now, life before Jake was tumultuous, to say the least. And what do I mean by that? I had no map. I had no process. I was a beginning investor looking for a deal. You know, beginning investors look for cash on cash, and they look for IRR. They don't look for a framework. They don't even know what a deal is. I lost hundreds of thousands of dollars before I met Jake, which was, to me, an excellent it was just an excellent thing to happen to me, because I needed to learn. I mean, I was actually motivated to go and become, in all these mentorship groups, because of all the money that I lost. Because I finally said to myself, I don't know what I'm doing here. I'm learning on the street here. It's time for me to learn in the classroom. I joined these mentorship groups, and I understood, and I started learning about the business, about what cash on cash was, what IRR was, what a cap rate is, how to underwrite a deal. And then all of a sudden I started creating our own frameworks. And then when Jake and we bought that first deal, back in 2013, we literally used our framework to buy this asset. And since then, we've been utilizing the framework. And I have to say, for anybody who's in real estate, I've never met somebody in real estate that has not lost money. Like, if you haven't lost money, then you haven't been in the business.
Yep.
I can honestly say the only person that I know is my business partner, Jake. He has not lost money on a deal since we started investing.
Wow.
But the caveat is that I lost the money. So, I mean, that's the thing. So go with the experience. The experience usually loses money. So for him, once our minds work, like, we have engineering minds, so we need a place to say, we want to really have something that's replicatable. We want to be able to look at a deal and go, is it a deal we buy and finance? Maybe. How do we operate this deal? And is there an exit strategy? So when you look at a deal from that perspective, things become clear. And we don't lack motivation. We lack clarity. When we do have the clarity to look at a deal and say, that's a deal, that's how we become successful. That's how 18 months becomes 6 months. That's how all of a sudden you're able to make decisions quickly, because you do have a framework.
So imperative. I know for me, I'm so big on commercial real estate because it's math. It's frameworks, it's strategies. It's not a lot of motion. In residential real estate, it's like Is the house pretty? Yes or no? Or the home stuff next door? And commercial like, does this make money? What can I make on my returns? How fast can I exit this deal? It's 9-day difference. And for you, what made you change from looking at commercial real estate for deals versus for the exit, like a real business?
That's another great question. I'm glad you asked that because my big mistake when I got into the business, I made a few really big mistakes. But the biggest mistake I think that I made and most beginning investors make is that we look at real estate as not a business. We
Mm-hmm.
look at it as just being a landlord. We
Yeah.
look at it as a process where there's no scalability, there's no systems, there's no processes. Real estate, like any other business, is income over expenses, and then you have a net operating income.
Mm-hmm.
Your job is to force that net operating income up and to create a a great asset. And how do you do that? In multifamily specifically, you have property management and you have asset management. You need to understand the difference between both. And
Yeah.
we did in the beginning. Property management is there for the customer service, the customer
Mm-hmm.
journey, the customer experience. They're not so worried about budgets. Well, that's where the asset manager comes in and they both make budgets together. They have to work together. The
Mm-hmm.
asset manager is what everybody should be. We all need to be asset managers when we're in real estate. We really need to drive the budget. We really need to know where income is, where expenses are. We need to know, as I'm looking at the fan, how much am I paying for that fan? Can I get away with $60 for a ceiling
Mm-hmm.
fan, or do I need to pay $150? Property management is not as concerned.
Yeah.
They want butts and seats. They want heads and beds. That's what they want. They want to make sure the occupancy is up. Asset managers want to make sure that the NOI is there. They want to make sure that what we look at in our properties
Mm-hmm.
is profit per unit. We want to make sure that our profit per unit is at a certain level. So they have to be working together. So when you ask me what mistakes or what did I do wrong, when you're not looking at a business in real estate from that perspective, all you're looking to do is to buy a deal. Hopefully you buy it for this price. You hope and pray things go well. The market cycle is going up, and then maybe you exit. Maybe you make a profit,
Mm-hmm.
but you never operated the deal. There's no operations in the deal, and that's where a lot of people see themselves in this part of the market cycle right now.
It makes total sense. I don't know if you can sell this or not, but like you've done over $350 million in production,
Mm-hmm.
ownership, which is insane. Congrats again to you. How do you structure your business now to like manage all that and to have that scalability and to like not, lose track of deals and miss opportunities?
This is the beautiful thing about life. You don't have to do it all at once.
Mm,
I can give you two quick examples of what that looks like. I have 6 children. When I got married, I didn't have 6 children. We had a child a year after we were married. Then we waited 3 years. We had our second child. So you can give yourself the grace and the time to scale and
mm,
to learn. And after 3 years after that, I had my third child. Let me give you the second example. Around 2 years ago, we bought a farm, about 6 acres, had nothing on it, had a nice house, and it had an empty barn. Well, we decided we wanted animals. So how do we start? We started with chickens. Only got 8 chickens. That's all we
mm,
got. A small coop with 8 chickens. We could see if we could manage that. Then from that, we started growing a garden. I'm a big gardener. I'm Italian. We love tomatoes. So I'm growing a garden. So I've got 8 chickens and I've got a garden. Then we've got the itch. Let's go out and see if we can buy some more animals. And we go out to the farm. Gentleman says you shouldn't get cows. Cows are really hard if you've never had
mm.
animals before. Get donkeys. Donkeys are a lot easier. All they do is eat. You don't have to take care of them. So we bought 2 donkeys. We bought Lucy and Buttercup.
Good
6 months
name.
after that, we're like, we want cows now, but we don't want milking cows. So we bought a little Angus steer. We named him Antonio. So we've got Lucy, Buttercup, Antonio. We've got chickens within the first year and a half of the farm. And then I said, hey, wouldn't it be cool if we got some honeybees? I want to pull some honey. We got a thing of honeybees. We got a nice hive of honeybees. 3 months after that, we're like, let's go big now. Now we're ready for the cow. We bought a cow who was pregnant. Baby gave birth to Rosie 2 months ago. Now we're milking a cow. 2 months ago, we went out, we bought a New Jersey cow. We bought a Jersey female. So she's pregnant. So as you see the progression, you don't start with 1,000 units. You start with your very first deal. You start with what you can handle. Think big. I was thinking really big about this farm. I was thinking about having 7 cows, 5 donkeys, have a couple of goats, have a really, we're going to buy a couple of horses. That's the vision. Great. That's where you want to get to. But that's not where you're going to start. You
Yeah.
need to give yourself the grace to start with a duplex or a triplex or even more. Maybe you start with a deal that's you're a limited partner. You're an LP in a deal where you're investing passively. But still, remember, I had to go out and I had to research and I had to learn how to grow my crops. I had to learn how to take care of chickens. If you're a limited partner, you still have to learn the business.
Mhm.
You still have to learn the frameworks. And then, and only then, once you've learned that, that's when you start investing. But my whole motto is think big, start small. And the last thing I would say about wrapping this whole thing up, I'll leave you with this because this is really important on this topic. No deal is better than a bad deal.
Mm.
Walk away. You know what I'm saying? Like
Yep.
if I'm looking at that cow and I'm like, you know what? Should I get it? Should I not? It's okay if you didn't get it because it's fine. You don't have to deal with it. But if you buy that cow, now you're the steward of that cow. You have to take care of that cow. And at some point in your life, there's going to be an exit on that. It's the same thing with real estate. You buy this deal. Once you buy that deal, you have to exit that deal sometime in the future, whether you're refinancing it, whether you're selling it, whatever that looks like. So make sure once you're able to pull the trigger there, you've got a responsibility to take care of that asset.
It's really powerful. And I think it speaks volume on like taking it slow and not having ambition still, but still
Yeah.
knowing it takes time.
Yes.
I think a lot of people, myself included, is like, I want to make $1 billion company, do all these amazing things, but like, it's not happening fast enough.
Yes. Yes. And it's hard because you're online and you're seeing everyone on Instagram. Everyone's good looking. Everyone's doing deals.
Yeah.
Everyone's driving Rolex, Lambos, and we were Rolexes. And you just got to pull it back and you really have to say to yourself, this is part of the legacy that I talked about. You have to say to yourself, I want purpose over popularity. I'm okay to put in the work. I'm okay to work hard. I'm okay to do all this stuff. I don't really have to keep up with the Joneses.
Yeah.
That's not what it is for me. And that's what never really motivated me to be able to keep up with other people. I just wanted to learn a framework that I could limit my downside risk and I can make really good decisions for our portfolio. And I think that's what everybody listening to this should be focusing on. Trying to limit your downside risk, trying to find a framework that works for you, and trying to make sure that ultimately that framework will allow you to make those decisions.
Do you change your frameworks based on down markets versus up markets when it's like super amazing, everything's selling above market price and so forth, versus now when everything's selling slow, not hard to find good deals? That change how you operate?
Yeah, what we do change with the framework is we change what we're buying in the framework. And I'll also add a caveat to that. We are focused on multifamily. We wanted to become the Chick-fil-A of multifamily and apartments, which simply means we wanted to really deliver superior customer service. And how do we do that? If we're into all of these different genres and these different niches, we're vertically integrated. So we manage our own assets. So from there, our whole goal and our whole vision was to stay in multifamily. There are some great years and there are some lean years. And for us, every market cycle presents itself different opportunities. When we started back in 2011, the affordable space, the C space, was vastly underpriced. 12 caps, 15 caps. So you could buy those kinds of assets at a material discount, add value, and ride the wave. Well, at around 2019, 2020, all of a sudden you have 4 caps in C properties. And, a couple of years ago, 4 caps with 6%, 7% interest, you've got negative leverage. So it's very difficult to buy older assets in this part of the market cycle when newer assets are around the same cap rate.
Yeah.
So that's what we've changed over the last couple of years is just the criteria of what we're buying. So we're buying newer assets. I mean, new assets right now from builders is what's really, if you can find those kinds of assets right now where they've built them, they haven't leased them up and they've got to get rid of them. You can buy those for discounts. But even assets, in the 80s, 90s, 2000s, the newer vintages is what we're looking at because those have significantly less CapEx requirements. There's value there. A lot of those assets have been owned for a long time by owners. Rents are lower than what they should be. So there's a value add component to that. But I think as far as the criteria, unfortunately, that does change because the market cycle changes.
Yeah. What do you think is like, before you said most new investors, they buy on cap rate, COC, IRR, and so forth, and now you've
Mhm.
changed to be a real investor and business owner. What is your big risk profile filter you have in place? So this is a grand slam deal, or this is a no go guaranteed.
Ooh, that's an excellent question. I think I'll break it down to three things that I look at when I'm looking at a deal right now. I'm always looking in our buy right criteria. I want to look at median income. And if median income is less than 50,000 in our market, I probably won't even look at that asset
Mm,
because you need to have 3 times rent. So if they're
yeah.
making $4,000 a month in rent, can they pay $1,200 in rent? Maybe, maybe not.
Mhm.
As rents drop and median income drops, your ability and the neighborhoods get a little bit more challenging to manage. So that was the first thing we're looking at with risk. I think the second thing we're looking at when we look at assets, we love to look at, in this part of the market cycle, townhomes. We love townhomes in our market, knowing what our market is, because
Yeah.
townhomes are more of like homes. They
Mhm.
they they command a much higher rent premium. They have more space in them. They typically have washer dryer hookups, so the amenities are great in that. So we're looking at that. And when we're looking at assets, we need to see some type of dislocation between operations and where rents are, and then also expenses. Expenses have really shot up a lot over the last couple of years. So expenses are less for us to control. But we're looking at the top line revenue. We're looking at any kind of fees that landlords are not charging or passing on or being able to charge. And we're
Mhm.
also looking at the ability to raise rents. We know where rents should be in every part of our market because we have assets all over the area. So if
Yeah.
we're looking at an asset that's renting at 1,000, but we know right down the street our assets are at 1,400, that's what we're looking at. So that's how you limit your downside risk. Limiting the downside risk is so important
Mhm.
because if you take care of the downside, as Donald Trump likes to say in the book, The Art of the Deal, the upside is going to take care of itself.
Yeah.
And the only way you do that in real estate is by understanding your market, understanding rents, valuations, population trends, jobs, demand for an asset, the ability for what you're seeing coming on. In our Knoxville market, we've had a challenging 6 months because we had a lot of supply side coming on. So for us, it was like, okay, let's hit the pause button.
Mhm.
Let's make sure if we're going to buy an asset, we're not competing with all that supply coming on. And if we're going to buy an asset, we need to underwrite it conservatively for the next 18 months where there's no rent growth. That's how you limit your downside risk. Now, Jordan, the flip side of that is you're probably going to do less deals,
Mhm.
but that's okay because I don't want you out there risking your capital to try to pencil whip a deal, to try to force a deal when you know that you're taking a massive risk and you're hoping that
Yeah.
rents go up. This is not a hope game. You
Mhm.
don't want to,
Not
you don't.
gambling.
No, you don't. Exactly. That's gambling and actually, looking at risk and trying to mitigate risk.
That's amazing. I love that. So, are you big on mostly investing in your backyard? I know a lot of investors, especially new ones, like I'll buy a deal anywhere in America. I don't care where it's at. But based on you, sound like you're saying it's better to know your market, know your expenses, know what's happening. Do you feel that way, or are you open to other markets too?
It's interesting. When I started back in 2008 by myself, I was living in what we'd call Putnam County. It was about an hour north of Manhattan. There were no deals in my backyard. I couldn't make any deals cash flow. So I ended up having to go to Rochester, which was an hour flight, but it wasn't in my backyard. And that's how I learned. And that's how I got the confidence to say, oh, I can invest outside my backyard. When Jake moved to Knoxville, he was quote unquote the boots on the ground. So
Mm,
he was in our backyard, so to speak. For me, when you're first starting out, if you can invest in your backyard, I would prefer that only because it's important to create habits. It's important to actually call brokers, do broker tours, drive by properties. And even if you aren't going to invest in your backyard, when you're first starting out, it's a great example of, hey, I'm not going to invest here. So I can pick up the phone. I can call Jordan. I can make a few mistakes. I can sound like an idiot. I'm not going to buy deals anywhere in that market anyway. So if you're first starting out and you have the opportunity to buy deals in your own backyard, excellent. If you don't, I would still challenge you to learn there because you can get in a car, you can drive, you
mhm.
can do a property tour, you can underwrite a deal, you can have a conversation with Jordan, and then all of a sudden you may find other investors that are investing outside of their backyard and you may possibly partner with them because the investing world is not huge. It's
Yeah.
not really, multifamily is not that big. Once you've gone to a few conferences, you start seeing a lot of the same faces.
Yeah, it's so true. It's a small world, especially
It
in
is.
commercial real estate. And speaking of buying deals, like there are so many asset types. What made you choose multifamily over something else?
It's an easy question for me to answer because I had the job.
Mm,
Remember?
yeah,
I
yeah.
was in the back washing dishes, and I
Polish.
said to myself, I can't go flip a home. I don't have the time to leave the restaurant to go buy a house and to change it and to flip it. And then I made a $30,000 profit. And then I've got to go do it again. I
Yeah.
was already on the hamster wheel. Why do I want to create
Yep.
another hamster wheel? And that's not to say that somebody is in a W-2 job or, and they're in sales. I think flipping homes and wholesaling is incredible. It's an incredible way to create equity. You need equity to be able to invest in deals.
Hmm.
My equity was coming from my business, from my job. So I had that. So if you're saying to yourself, I'm going right into multifamily, that may be a good option, that may not be, but you need some type of equity, whether it's sweat equity, whether it's seller finance equity, or whether it's your own equity. I think that's important. So for me, I'm like, I don't want another job. I want to go straight into, building a small portfolio. And for Jake and myself, that very first deal was 25 units. I partnered with my brother. So the three of us, if you think about it, it's 8 units each. If you really break it down,
Yeah.
that's something that I could handle. And we had a seller finance component in the deal as well. So when I'm out there making that decision, I'm like, huh. And then from there, the beautiful aspect of it is you just start buying assets, start buying one after another, you're taking your time. And
Mhm.
some deals you may want to hold longer term. Some deals you may want to sell, pull out that equity and go buy a bigger deal. That's why it's very important to really be crystal clear on what you're trying to accomplish. For me, it wasn't getting another job. I didn't want another job. I already had one.
Mhm.
I wanted to really create wealth and really get some type of tax benefits as well
Yeah.
to my life.
Yeah, definitely. And you mentioned like Donald Trump's book, All the Deal, and he's big on leverage. For you, are you the same way? Do you love getting a lot of leverage? Are you pretty conservative when it comes to buying deals, paying them off, getting sell one, buy a new one? What's your philosophy there?
I think leverage is misconstrued by the average American. If you don't understand real estate and you're not experienced, leverage is a two-way sword or a
Mhm.
two-way street. If you use leverage incorrectly, you're going to blow up and it's just going to amplify your losses. You need to understand that. When you're first starting out, 75% LTV is probably where you should go. For us, we had an 80% LTV deal, but then we got 10% seller financing. The
Yeah.
reason why we did that is because the income was great on that property and the
Mhm.
expenses weren't that high. So the deal made sense. Now, leverage can be looked at as also leveraging other people's time, right?
Yeah.
That's what multifamily allows you to do. All of a sudden, you're hiring people. That's where the business aspect comes in. You have a property manager, you have a maintenance tech. Remember, your best and highest use is being that asset
Mhm.
manager and that property manager managing those people. And I think leverage is so important when it comes to that aspect. Now, for us, what I love about real estate is our model is to buy a deal, typically with community bank on the front end. And when we buy community bank on the front end, we look at that community bank or even that credit union, because
Yeah.
credit unions have been really cool for the last couple of years. We look at it as a bridge. We look at it to stabilize the asset. We get pretty good terms from community banks. And within 5 years, we're able to refinance back to either that
Mhm.
community bank, pull out some capital, or go directly to an agency lender. And it's really cool. We're doing that right now. We bought a deal back in June of 2023. We bought it on a 3-year credit swap. Interest rate was 7.25, 3 years of IO. Right now, we're
Wow.
getting a quote from Fannie for 5.3%. We have an $8.9 million loan on it. We're actually going to have a new loan for 12.5 million. So we're extracting $3 million of equity out of this deal. The payment is basically staying the same
Mhm.
because we went from a 25-year AM, which was interest only at 7.25. We're going to a 30-year AM, but it's 5.3%. What's awesome about it, it's 5 years of interest only.
Oh, wow.
Phenomenal.
That's
10-year term, 10-year term, and it's going to non-recourse. So it's coming off of our
Mhm.
balance sheet. That $3 million is basically a loan to us. So we're not paying taxes on that loan. That's the incredible part about real estate.
Mhm.
That's the leverage we're talking about. Do you know how many pizzas I got to make $3 million? And I have a third of that deal. So it's
That was
$1 million.
tough.
You gotta gross 1.6 to probably net 1 million.
Yeah.
That's a lot of pizzas. So that's the power of real estate. It doesn't happen overnight, but if you're willing to stick out 18 months to buy the deal and to buy the
Mhm.
next deal, 4 or 5 years down the road, these deals they're not possibilities. They can become probabilities. And that's how you use leverage wisely. The deal is still going to have about 65 to 70% leverage. So we are not over levering ourselves. It's going to cash flow really nicely because the operations of the deal, we've added probably a 30 to 35% of net operating income on the deal. And the great part about it is it's interest only for 5 years. So 5 years from now, when that principal resets, where
Mhm.
do you think rents are going to be?
Oh yeah,
Rents are probably going to be up another 15 or 20%. So when that principal resets,
it
we're
pays
going
for
to be more.
itself.
Exactly. Exactly.
That is the power of real estate. This economy is made by people who invest in real estate and invest in businesses. So it's made for people like us who are in the game all the time. So that's why it's so powerful. And not only would it take a lot of $1.6 million gross pieces, but a lot of time too. You probably didn't spend as much time managing that deal as you would making pieces.
Yo, you telling me I want to really, as we're wrapping up, I think this is important to mention. I think most people don't understand why real estate is so powerful. And I'll bring everybody back to August of 1971, the Bretton Woods Conference. And why is that important to mention? It's important to understand history because when the US government, I call that the day of infamy. We think of Pearl Harbor as the day of infamy. I think that day is a day of infamy because that's the day that we pulled our currency off the gold standard. And
Mm,
all of a sudden, they were able to print dollars. And if you understand that, then you understand that currency is a fiat currency. They can
mhm,
print more, and that inflation basically is a silent tax. The way that you combat that is by buying hard assets, by
yeah.
buying real estate. And what happens is inflation occurs, rents went up, asset values have gone up. And that's why people who own their own homes over the long term, it is an inflation hedge. You buy a home back in 1980 for $42,000. That home today is probably worth $600,000.
Mhm.
You've paid down your debt and now you have an asset free and clear. You've got a ton of equity. That's the problem. Understand tax law. Taxes are written to stimulate behavior and understand what they did to the currency. Once you understand those two things, you're going to shut this podcast off and you're going to go, where do I find, how can I get into
Yeah.
real estate? Because that's the power. And it's not like you need to do 1,900 units. If you even buy one house for the next 3 or 4 years and you hold on to those for your retirement, you're well ahead of 95% of the population in this country. That little switch. But I'll promise you, once you've bought that third deal, you're going to be saying to yourself, boy, this isn't as hard as I thought it was.
Mhm.
If the pizza guy and the drug rep can do it, I think I can do it. And look how cool this is. My equity's gone up. These people are paying my mortgage. The government's giving me these tax benefits. How do I do more? How do I do this more?
I love that. Yeah, it's so powerful. And then, like, you talk a lot about mindset and obviously money as well.
Mhm.
At what point did net worth stop mattering to you? You start prioritizing lifestyle and this making a legacy. When that switch for you?
I always thought legacy was important because I needed it to borrow on assets.
Hmm.
And I think legacy can be a vanity number. I mean, you can't eat your net worth, but you sure can borrow against your net
Yeah.
worth, right? And,
Hmm.
and I think the important thing is that most people in their retirement don't have a net worth problem. They have a cash flow problem.
Mm.
So I look at it from both perspectives, from both sides. Net worth is really important. It is a vanity number, but for me, I want to use my net worth and leverage my net worth to be able to create more cash flow. That's the power of real estate. That's why I think real estate is so cool because it is a business. It does generate cash flow every month. But as you're doing that, you're able to increase the net worth. So for me, when I look at people trying to grow their net worth and they're growing these businesses to exit in 5 years, they're
Hmm.
creating an amazing liquidity event.
Yeah.
Their net worth is going to grow exponentially, which is great. But then when you have all that net worth, you have a taxable event
Hmm.
and then you have no cash flow coming in. But at that point, you can take that money and invest it somewhere. So for me, the whole goal was in the beginning to try to get to a cash flow number where I felt comfortable money coming in every month. For me, it was around $15,000 a month. I had 6 kids. I was living in New York. Once I hit that number, I'm like, okay, great. But I always realized, and I'll leave it that the answer with this quote: cash flow will get you out of your job. Net worth or equity will keep you out of your job, and that's really important to understand.
I like that. That's really good. On that point, what would you say for somebody just starting off, trying to get into multifamily, and they have 100K? How should they do it? Should they buy programs? Should they find deals? Should they see syndication? What's your thought process, your framework, I guess, about people just now starting off?
This is when you have a come to Jesus moment with yourself. And you ask yourself, how serious are you? Are you serious to safeguard that $100,000? Do you want to put that $100,000 to its best use?
Hmm.
I can tell you what I did. I had my $172,000 and I ran out and I found the guy named Maserati Mike who's driving a nice yellow Maserati, and I invested it with Mike. That $172,000 lasted about 6 months and then it vanished. That's what I don't want you to do. What I would love for you to do is I would love for you to find a community, and I'm not teaching education anymore, so I have no skin in this game. I would challenge somebody to go out and to find a community, a group that focuses on whatever niche you're trying to learn. That could even be Bitcoin. Try to learn as much as possible about what you're investing in, where you're putting your money in. The next component to that is trying to understand what you want to accomplish with this $100,000. Do you want to use this as a launch pad to launch yourself into the business of real estate? Or are you trying to just use that money to start investing to learn? Or are you using that money as a limited partner and just trying to do it passively? You need to be clear on all of these questions before you start going out there and chasing deals, because that $100,000 could be put passively into a deal. You don't have to worry about it. Or that $100,000 could be used to go partner with somebody, and then you can be the operations of the group. Or you can take that $100,000 and go out and find a group that needs help in raising capital. You can be part of their team, and then all of a sudden you're on that team and you're helping them with that deal. So there's so many different ways
Mm-hmm.
to look at investing in a deal, but it comes back to, please, you have to understand that some change needs to happen in your life. And the biggest thing that happened to me in my life when I completely changed is I started to identify as a real estate investor. All of a sudden, I started saying, you know what? I'm the multifamily guy. I'm not just a pizza guy. The multifamily guy does certain things. They underwrite deals. They go to seminars. They talk to brokers.
Yeah.
They put in letters of intent. They close deals. They start talking to investors. All of these things. And once you can start identifying as one, for you, you'll have the confidence to be able to pick up the phone and go, oh, okay, no deals. And that's the mindset that you want to get into. Put the money aside. You need to invest in yourself. You need to invest in your education. That's an important component to it. You are the biggest asset that you could ever own. You're the one who's going to continue to make more money for yourself. So why wouldn't you invest in yourself?
Amen to that. I love that. So key. I think it's about not being a spectator and being part of the game. After getting in there, being an investor, at least the mindset behind that, learning the skills, meeting people like Gino, who's just changing the industry and really get in there and get hands dirty. And to kind of wrap up a few more questions for you, really makes this impactful for our viewers here. What is something that you believe that most real estate investors will disagree with?
Oh, I love this question.
Glad to hear it.
Excellent question.
Thank you.
People always say that they make money when they buy real estate, and they may. They make money when they sell real estate or when they exit. Very simple illustration. You buy a home for $100,000. You may get $100 in cash flow a month, $200 in cash flow. At the end of the year, you made yourself $2,000 in cash flow, which is great. But you hold on to that deal for 3 years. House is probably worth $150. You just made $50,000 in equity, but you made $8,000 in cash flow. Now, that's not to say that you don't need the cash flow, because you need to pay the bills and you need to put some money in your pocket. And people are saying, well, you made money in the buy. No, you made money on the exit. And that exit is either a sell or a refinance.
Yeah.
That's the key to real estate, in my opinion, is being able to have these liquidity events. And then on top of that, to continue to fuel the business. I was fortunate because in 2011, I started with Jake. I had my restaurant, which was paying my bills. So for 5 years, I had the double hustle going on. Everything that I made in the real estate went back into the real estate business. The restaurant fueled my lifestyle. And at one point, when I got into 2016, I hit the number that I needed. But that's important. You're not making money on the buy. You
Mhm.
may say to yourself, you're buying it right, but you haven't exited it.
Yeah,
The deal is there. You're making the money when you can matriculate that equity and extract that equity and move on to something else.
that is amazing. I think a lot of investors would disagree with that because they are not thinking about it like a business. They're thinking about it as a side
That's right.
hustle, as a
That's
job.
right.
You gotta think about like a business. How can I make this a huge liquidity event for
Yes.
ourselves?
Yes. And it's interesting because there's a lot of business books out there. Buy Then Build,
Mm,
Built to Sell. John Warlow is a
yeah.
great author. You can go to our website, jakeandgino.com. We've interviewed him. Great book. It's Built to Sell. You're building a business or you're building or a multifamily, you're building it to be able to have a liquidity event. That's where you make your money. People are running businesses and they're cash flowing and they're doing really well with their businesses. Great. But when do they make the most amount of money? It's when they exit that business. It's the
Mhm.
same principle in real estate.
Oh yeah. And then on the same note, what is the hard truth that people in multifamily don't realize?
That's a softball question you just gave me. You gave me another easy question. The quick answer to that is it's not passive.
Mm,
Let me reframe that. It may be passive if you've got $50 million in cash sitting in the bank and somebody's running it. It may be passive to you, but it is not a passive venture. It is an active operating business. And once you understand that, there's moving parts. You're renting out apartment homes, not units. We call them apartment homes to residents, not tenants. And these
hmm,
people are having and creating lifelong memories in your apartment complex. Once you understand that, there's nothing passive around that. And once
yeah.
you can build systems and processes around that and have a good team that's trying to run that asset, things become a lot clearer. The goal for most of us is to create an operating business where we can operate it and at some point in our lives become passive. But what I've realized is most of us who've had that kind of success just love the hunt, just love
Mhm.
the game, just love the business that we don't want it to be passive because we weren't wired that way. We love to work. We're not
Mhm.
working ultimately for the money. Money's the result.
Yeah.
Money is impact. Profit's the fuel. It's not the destination for
Mhm.
most entrepreneurs and for most of us who get into real estate and understand, wow, this is pretty cool. 100 units, great. Let's go to 200. Let's go to
Mhm.
500. It's not the money that we're working for. It's the impact, and it's also the fact that you feel great in life, that you're doing something that you're really good at, and that you're actually creating impact for others. So I think that's the misconception. It's not passive.
Yeah, definitely, especially if you not want to be a good landlord or a
Yes.
good investor, like, it's all about the customer experience. I can tell that you're from hospitality based on how you think about giving them the best experience, having it be apartment homes, not just units, and residents versus tenants. I love that philosophy you have there. And let's say, Lord forbid, you lose everything today. You just start over in the next 12 months, rebuild from scratch. What do you do?
If I lost everything today, I'm fortunate because I have older children. I'd make them go to work and say, guys,
There you go.
we're going to rent a little 3 bedroom apartment. There's 8 of us. We're gonna get a 3 bedroom apartment. We're gonna cut it down our bills to nothing. We're gonna save as much as possible. I'm gonna go out and I'm gonna get a realtor's license. I'm gonna go out and start selling real estate. That's what I'm gonna
Mm,
start doing. And I'm gonna start looking at deals. And that's where I'm gonna start. And it's very interesting because right now I've had that mindset where about 80% of my income I'm saving right now. I'm living on 20% of my income right now.
I
So it's
love that.
easy for me to scale back. I don't have a lot of debt. I have no personal debt. I've got very small mortgages on my homes. So I'm able to withstand that. And I don't have that urge to have to go out and spend money. So I've already conditioned myself to say, hey, if I do lose money, I'm able to take a step back. I'll just cut my spending back to zero. I'll have the whole family pitch in. Let's work together and let's build this thing back up.
That is a solid plan. I love how you're really mindful with your money you have. I think a
Yes.
lot of people are like, if I make $1 million, I live on $1 million. Like, that's the easy way to be super stressed 24/7.
Mhm. It is. It's unfortunate because I know a lot of people who earn seven-figure incomes and they are quote unquote almost living paycheck to paycheck, and there's chaos in that life, and
Mhm.
it's unfortunate that that's the pattern that they probably developed from
Yeah.
their family, or the pattern that they're trying to avoid from their family. right? That's
Mm,
one of the two things. You either are adopting patterns or you're trying to do the complete opposite. Once you start realizing that and you're saying, huh, how do I become more financially intelligent? How do I build the financial foundation so that when I do make seven figures, I can save 10% of that. I still don't want to deny myself certain pleasures. We
mhm.
don't want to do that because if you start cutting up all your credit cards, great, you're going to become savers. 6 months from now, you're going to have a relapse.
Yep.
And that's the problem. You do not want to deny yourself. You just want to become more aware. You want to
Mm,
understand that feeling that you get of why am I spending so much money? What is that feeling? What's going on? Why am I doing that? Start asking yourself these questions. And the better questions that you ask yourself, those answers will start popping up. They'll start revealing themselves to you.
that is so powerful. Have you always been that way? Like super like mindful on how you spend money, or something you learned along the way?
Unfortunately, as I told you, my parents were immigrants and we had the saver mentality. It was more of a scarcity, fear set mindset. I've most people that I've spoken to and coached, most of us have that fear and that anxiety and that scarcity around money because that's how we were raised. That's how we're taught. And I was fortunate to go to life coaching school. I was fortunate to become a money coach. I was fortunate to go through that journey and to say, wow, do I need to really believe what I believed when I was younger? Can I challenge that? And then once I started getting into real estate and all those beliefs that it takes money to make money, yeah, but I'm just using somebody else's money. Or money doesn't grow on trees. Yeah, but I'm just refining a deal. I'm pulling out $1 million and I only put 600 grand into it. So I'm just created $400,000 out of my 600,000. Once you start doing that, you're able to start
Mm,
challenging those beliefs. And once you start surrounding yourself with people who are more abundant than you, and you start raising your standards and your levels, and you're getting into bigger rooms and to different rooms, and that you start changing the tribe that you're hanging around, things start changing. And that's been my journey because I
mm,
was the scarcity person. I was the saver person. I was the person who saved for a rainy day, never for a sunny day, always for a rainy day. That's how I was conditioned. And
mm.
it served me until it didn't serve me. And then when it didn't serve me, that's when pain showed up. And that's when I started going looking for answers.
That is a really powerful journey you've been on. I can definitely tell how it really
Mhm.
shaped who you are. I think a lot of times entrepreneurs, we chase, $1 million, $10 million, $100 million net worth. But what's more important is who you become in the pursuit of making all that money and doing
That's
those
right.
different things.
That's an excellent. I love that point you make. And as we're wrapping up, I think this point is really important to make. If you're a parent, if you're a spouse, and you're saying to yourself, "Yeah, I'm chasing $100 million net worth. I'm doing this for my kids." I've heard that so many times, and it's such an admirable and a noble thing to say because I am doing it for my kids also. But I would challenge you: have you ever asked your kids, "Is that what they want?"
Mhm.
Just stop and ask them.
I love that.
I'll probably venture to say that that's not exactly what they want.
Mhm.
You have to stop and say to yourself, is that what you want? And it's okay if that's what you want.
Mhm.
Just be clear. And then the next question is, why do you want that? What's driving you to that? And is that the right goal? Should you be in real estate or should you become an artist or
Mm.
should you do something else? That's where people ultimately achieve and arrive at that mountain that they think they want to climb. And then they get there and they're like, why am I here? I
Mm.
thought I was supposed to be on top of this mountain. I thought I was supposed to get 1,000 units in multifamily. I've
Mhm.
gotten here. Well, maybe that's not the mountain you're supposed to be climbing.
I love that. So before this podcast started, you were saying that host everything's mindset. And some people should do real estate and some should not. What would you think are the people who should not be in this business?
I can think of possibly two examples of people who shouldn't be in this business. I think the first example is people who are not willing to work hard.
Mm,
It is a hard business.
yeah.
It's an unforgiving business. It's a lonely business. And I think the second type of person who should not be in this business is if you're not willing to take a no.
Mm,
If you can't take rejection, then just don't be in the business. And I'm sorry, there is a third one. I should add a third
mm,
one. The third one is if you don't have a long-term mindset. If you're getting into real estate, you're getting your realtor's license and you haven't sold anything in 16 months, that's probably okay. If you stick with it, by year 3, you're going to have some pretty cool numbers.
yeah.
So if I had to say those are the three instances of if you're contemplating it, hard work, willing to take no, and being able to have that long-term mindset. Those are the three key factors you need to say, am I willing to be in this business or not?
For those watching right now, like take a look at yourself and actually ask yourself these questions. Are you willing to
Yes.
work hard, get rejected, and have that long-term mindset? Because again, this is the best industry in the world, in my opinion. It changed my life. I was homeless as a kid, and now I'm selling houses and buildings. Totally different, all because I had that long-term mindset to get to where I'm at now. And Gino as well, from being a restaurateur to now owning $350 million in real estate assets. You
Mhm.
can too. And for the last question, Gino, if you lost all your podcasts, all your books, all of your websites and credentials, what would be your final message to people right now watching this?
Wow, that's an interesting question. If I lost everything, I would probably have to say trust in God. I mean,
Mm,
there's a reason why I lost it all. It's not. I've always been of the mindset that, and I can do it all myself, make it happen. But I think ultimately, I think if you lose everything, there's got to be a reason why you lost everything, and there's got to be a lesson in that. And what's the lesson in that? And what is God trying to tell you?
have faith, the pillar
Mhm.
legacy.
Yes. Mhm.
And then anything you want to add to this podcast you want to miss? You want to have one last message to people?
I would say, Jordan, what made you want to get into real estate?
That's a great question. So I was homeless as a kid from 12 to 18, off and on. And I knew what it felt like to not have safety, to have security, and to be longing to be in a house. And because of that experience, I realized that real estate was my goal, my passion, to help other people get into houses, build wealth, and have a true legacy, you were saying. And I started off in residential real estate, moved into commercial real estate, and I realized how powerful this is, helping make more wealth, and now I will die doing this kind of work.
So when you got into it, you had no background, you had no foundation, you had nothing. Like, so what got you started? What got you started into the business?
Yeah, so I owned a marketing agency a decade ago. And for the first 5 years, I did marketing for agents and for investors,
Ah.
and helping them sell houses, get clients, and all those things like that. And I was like, wow, I love real estate. I'm making a lot of money. I should do it for myself instead. And fast forward, my team's 100 people. We did $1.6 billion transactions in the past 5 years.
Mhm.
And so I understand it's marketing and also having that customer service. It's all about
Mhm.
the people. It's a people business, not a real estate business.
Yes. So I would say, just to wrap up the show, honestly, if there's a homeless guy, a pizza guy, and a drug rep, if the three of us can get into commercial real estate with no background in real estate, if
Yeah.
we can do it, then anybody can do it.
Amen to that. And then for those watching, please, please, please follow Gino on all his platforms. Here is his website. We have access here. Check him out. He will change your life, and especially out his best-selling book, Real Barrel Profits. We're going to teach you how to create passive income, build wealth, and take control of your destiny through multifamily, which is, in my opinion, the best asset class out there. Gino, thank you
Amen.
so much for being here.
Thank you, brother. Have a great weekend.
You as well. Talk to you all soon.